I have targets this year for gold of 6,800. I've moved it up several times over the last couple of years. I had a target at 3,000 a few years ago when it was down in the 1,800, 2,000 area, and then raised it to 3,400, and then 4,000, 5,000, and then 5,500, and in February after the sell-off in both gold and silver, I raised it to 6,800, and that's my current target for what I call a pre-bust target, or it could spill into the bust, but basically it's my target for this year. In the bust, all assets are going to get hit hard, except maybe treasuries. I raised that last year to 100 and then 125. When silver went from 50 to 122, my target was 125, so it had pretty much gotten to my target, and it was parabolic, and I could have easily looked at that and said, well, that's it. That was what I was looking for, and we're there. And parabolics usually end cycles. I didn't. When it sold off and went down into the 60s, basically down to mid 60s, I raised my target to 180, and that's where I am today on that. And again, that's a this year target. Could be there this summer, might spill into fall, but I think we're going to see it pretty fast. We've spent the last few months, really since that peak at 122 on silver and, at 5,500 on gold, we've spent the last few months kind of consolidating that big run. That was a huge run in both metals. And then the war hit. It might have come out of the consolidation much sooner, but the war hit, and it took another, I didn't expect it at the time, but instead of what I thought had been a retest, it went to new lower lows. At least silver did, and gold did too. And we've kind of been fooling around for the last month trying to figure out what direction to go. A lot of technicians and a lot of traders have taken the bait and gotten bearish here, and so it's going back. Silver's going back to the 50s, and gold's going back under 4,000. I did not.
Despite the Fed claiming inflation is contained, central banks are hoarding gold at crisis levels. Rising price targets after sell-offs show institutions are buying, not panicking. This rapid shift signals a total loss of confidence in fiat money, changing everything for everyday index investors.
I have targets this year for gold of 6,800. I've moved it up several times over the last couple of years. I had a target at 3,000 a few years ago when it was down in the 1,800, 2,000 area, and then raised it to 3,400, and then 4,000, 5,000, and then 5,500, and in February after the sell-off in both gold and silver, I raised it to 6,800, and that's my current target for what I call a pre-bust target, or it could spill into the bust, but basically it's my target for this year. And then for gold, on the other side of the bust in that big inflation cycle, I think gold can go to 20,000. And that would be in the early 2030s, not 2030, but 2031, 2, 3, somewhere in there. My target on silver has been raised several times as well. I had a long held target of 75 when silver was back in the 20s, even the teens. I said it can break out from the old highs of 50 or 48 and go to 75. I had that for several years. Kept saying, I think, we're close to a bottom here. We're very near an inflection point. And I think today, pretty much, assuming this isn't just going to be one day news and then we go back the other way again, I think today may have been that turn back up, that we've completed the consolidation. And we should see a pretty fast run, meaning over the next few months, 3, 4, 5 months, with silver going from, the mid 70s here up to 180, and gold going from, where it is now up to 6,800. Post bust, gold can get to 20,000, as I said, and silver can get to 1,000. I had thought 500 was going to be kind of a crazy number, and after seeing what we've seen this year, I had to raise it. And I think Silver at 1,000 may sound crazy, but I think that's very doable for, early next decade.
When silver collapsed recently amid global fears, the public panicked, but big institutions didn't. This drop wasn't the end, it was a forced reset. Historically, huge commodity bull markets use violent drops to shake out retail investors right before a massive, explosive breakout higher.
So I don't have a number in terms of the bust, but I do think the likelihood is that in the bust, all assets are going to get hit hard, except maybe treasuries. But silver could fall 50, 60, 70% or a little more because it is so cyclical, and it will have been bid up so high. And gold, less so, but it could still fall 30 or 40%, maybe even a little more. And that's obviously not so crazy anymore when you see what happened, after January. I mean, we saw a 50% hit in silver in days. And we saw gold go down 30% or more. So I think, that makes sense to me that you will see 40, 50% gold and maybe that much, and 70 maybe more in silver. No guarantees. I mean, they could hold up better than that, but they're going to be hit hard one way or the other. And then coming out of the bust, that will present a very big buying opportunity, because if you can, let's say my 180 is right, and you go down, more than 50%, let's say get back to 70. You could go from 70 to 1,000 in less than 10 years, and certainly 5, 6, 7 years. Or gold, let's say it gets back down from 6,800 back down to the 4,000 area, 4,500 area. It can go to 20,000 in that same 6 or 7 years or less. Those will be great opportunities. What we'll see next cycle, I think, is because of rising interest rates, sharply rising interest rates where they go double digit, and because of inflation, the indexes, the broad indexes like the S&P and the Dow and the NASDAQ, are going to be held back as PE, the market multiple gets shrunk. PE multiples get shrunk. Because they're the inverse of interest rates, right? So if rates go up, PE multiples tend to go down. You could be back in a period where normal PE multiples are more like low double digits or single digits, because inflation's really taking a toll. And so it's going to be a cycle of commodities. As I said, copper can go up a lot, natural gas can go up a lot. I think even ag commodities could go up a lot in the next cycle. And so those things will be able to outpace inflation. And certainly the stocks connected to commodities like miners or oil stocks or oil service stocks, they're going to be able to outpace inflation, so their stocks can go up. Whereas, let's say, steady growers like, the foods or the drugs or, things like that, consumer stocks in general, they're going to have a harder time because they're going to be facing cost pressures, and they're not going to be able to produce earnings that can come anywhere close to what inflation's doing. And so their stocks are going to, at best, tread water and probably go, in many cases, go down. So they'll be underperformers. And again, for people that are in indexes,
many believe gold guarantees protection during crashes, but initial panic selling spares almost nothing. The true opportunity comes when exhausted investors dump assets at the worst possible time. Institutions actually wait for these catastrophic drops to aggressively invest, destroying buy and hold retail savers.
I like to recount the fact that, because I've been in this business 50 years plus, I remember when in the mid 80s, the financial industry decided we're looking at the rat going through the snake. The baby boomers are now reaching a point where they're going to start accumulating assets for retirement. They've bought their houses, they've bought their furniture, and they've got excess money that they now are, starting to put into savings and retirement savings. And so the financial industry knew that they had this new trend coming that was big, and they said, we got to figure out something that kind of we got to get away from our kind of churn and burn type of approach to investing, where a broker dials you up and says, I got a stock idea for you, and they moved to the idea that it's time in the market, not timing the market. And that mantra has been around for 40 years. And for those that followed that, which is the majority, I think, of retail investors who index, they bought into that, and they've made out like bandits, because the S&P's had a great run. All the indexes have had great runs, and you were much better off most of the time just buying and holding and let it go from cycle to cycle. So we've seen in many cases, and I think in the majority of cases, those that did that from the mid '80s on have outperformed most money managers, most professional money managers, active managers. And so, that's still the mantra out there, and that's still the belief that there's always a higher market next cycle. Yes, the cycle has corrections, and yes, the cycle has bear markets. But if you just kind of play the steady as she goes, buy and hold, you'll be bailed out by the next higher high, and the higher market cycle to cycle. I think we're making a final top this year in a what will ultimately probably be a 44-year secular bull market. That high may stand for decades, not a decade, but many decades, just like the high in the Japanese market in 1989 was not surpassed for many decades. I think that's what we're looking at. This is a very big picture top that you won't get bailed out by just stocks always going to higher highs. We're so conditioned for 40. If something happens for 40 years, that's something that people think is forever, but it's not. And I do think that we are looking at a situation where you have to kind of think about changing your philosophy, changing your strategy from time in the market to timing the market. If we in fact are, and again, I can be wrong, so I'm not saying I know, but if I'm right, if my thesis is right, that we're making a 44-year top and then followed by what could be as much as an 80% bear market, obviously it would make sense to take advantage of this run we've had for 40 years and get defensive, maybe get out of the market, be in cash or be in treasuries, where I think they will continue to provide you, if not positive returns, not negative returns. And treasuries, I think it'll be positive returns. And then prepare to redeploy the funds as we get through the bust. And then
American investors assume U.S. indexes are immune to historical crashes, like Japan's decades-long slump. We may be hitting a 44-year market top, but people blindly keep buying dips. If central banks stop rescuing the markets due to inflation, passive retirement portfolios face generational destruction.
But redeploy them in areas other than indexes, maybe, into commodity stocks or commodities or, funds that are oriented in that direction. Because the other thing that's going to happen on the other side of this is if you look at an index, it's most heavily weighted in the leadership of this cycle, right? So technology and AI and semiconductors, those kind of things have got very high weightings in an S&P, for example, whereas oil's got a very low weighting. It's, I don't know what it is now, but it was just a few percentage points. It may be up to 5% or more now, but it's still a very low weighting. Commodities are generally pretty low weightings. And although they'll be in the bust, there'll be changes in that. Ultimately, the heaviest weightings are the last cycle's winners. And so if you buy an index, you're positioned all wrong, because you're positioned for last cycle's winners and not the next cycle's winners. So again, it will behoove investors to think through that process with their financial advisors and move more towards what it, invest for the future, not invest using a rear view mirror. And so I don't think most people think that way. They kind of just do things as they've worked for so long. They just say, hey, why should I change? And most of the time they've been right to take that attitude. We're coming up to a very big turning